Gold just did something that broke every rule investors thought they understood. On October 20th, 2025, gold hit an all-time high of $4,381 an ounce. The metal was up over 50% on the year. It was the best performing major asset on the planet. Central banks were buying, retail investors were buying. Every headline screamed the same story. The world is losing faith in paper money, and gold is the answer. Then, less than 24 hours later, it fell apart. Spot gold plunged more than 6% in a single session, its worst one-day collapse since April of 2013. Over $2 trillion in market value vanished in an afternoon. Silver got hit even harder, tumbling nearly 9%. Think about that whiplash. The morning after the greatest rally of the decade, gold suffered its sharpest one-day fall in over 12 years. If you'd asked any textbook what should happen to gold when the dollar wobbles, when geopolitical tension simmers, when debt keeps climbing, the textbook says gold goes up. It did the opposite. It cratered at the exact moment it was supposed to shine. People online didn't take long to draw their conclusions. Comment sections filled with the same line over and over. This was deliberate. Someone did this on purpose. Someone wanted gold lower, and they made it happen. Here's the uncomfortable truth. They're right. But not in the way they think. By the time we're done here, you're going to understand three things you don't currently understand about how gold actually moves. First, who actually sold gold that week, and why. For each of them, selling wasn't a choice, it was a necessity. Second, the one overlooked data point that proves this wasn't a structural breakdown in the gold thesis. It was a mechanical flush. And the data is hiding in plain sight in the futures market, not the headlines. Third, the deeper structural plan connecting gold's long-term path to a number most people aren't watching. The cost of servicing roughly $38 trillion in U.S. federal debt. By the end of this, you will never look at a gold crash headline the same way again. Let's get the timeline exactly right because the order of events matters more than the headlines suggest. On Monday, October 20th, gold touched its all-time high near 43.81. The rally leading into that peak had been almost vertical. Gold had ripped from under $3,000 earlier in the year to this new record in a matter of months, an ascent so steep that even the people buying it were nervous about how fast it was happening. Volatility readings on gold options had spiked to levels rarely seen outside of genuine financial panics, and that's the tell almost nobody talks about. A spike in volatility at a price high isn't bullish confirmation. It's usually the market's way of telling you that positioning has become dangerously one-sided. The headline explanation everyone repeated afterward was simple. U.S.-China trade tensions eased, risk appetite came back, so safe haven demand for gold dropped. That's the story Reuters and Bloomberg both ran with, and it's not wrong exactly. It's just incomplete. It explains the direction of the move. It doesn't explain the violence of it. A 6% one-day drop isn't sentiment shifting. That's positioning unwinding by force. The data point that actually explains the magnitude, the one buried under the trade optimism headline, is the open interest and leverage data sitting inside the gold futures and options market in the days leading into that peak. Heading into the high, options markets were pricing an extreme one-sided bullish positioning, the kind of lopsided bet that requires almost no external trigger to unwind violently, because everyone is leaning the same direction at once. That imbalance, not the China headlines, is what turned a normal pullback into the sharpest one-day fall in over a decade. So now you have the real sequence. Record high on momentum and crowded bullish bets. A modest piece of risk-positive news as the spark, and underneath it, a leverage structure so stretched that the spark didn't need to be large to cause an avalanche. Here's where we need to slow down, because this is the part that actually matters for understanding gold as an asset, not just this one crash. Gold does not primarily respond to fear headlines. That's the popular narrative. War breaks out, gold goes up. Inflation report comes in hot, gold goes up. And sometimes that correlation holds. But it's not the mechanism. It's a coincidence that happens often enough to fool people. The actual mechanism running underneath gold's price, almost all of the time, is the relationship between three forces: real interest rates, the strength of the US dollar, and the global liquidity environment, meaning how easy or hard it is to borrow money and how much cash is sloshing around the system. Walk through it step by step. Gold pays you nothing. No dividend, no coupon, no yield. So the cost of holding gold is what you give up by not holding something that does pay you, typically a U.S. Treasury bond. When real yields are high, meaning the interest rate on a bond minus inflation is high and positive, gold becomes expensive to hold relative to that alternative, because you're sacrificing real positive income to sit in a metal that pays nothing. When real yields are low or negative, the opportunity cost of holding gold collapses towards zero, and gold becomes the obvious place to park capital. That's why gold's biggest, most durable bull markets in history line up almost perfectly with periods of negative or collapsing real yields, not with periods of maximum headline fear. Second force, the dollar. Gold is priced globally in dollars. When the dollar strengthens, gold becomes more expensive for every buyer outside the United States, in euros, yen, rupees, yuan, which mechanically dampens global demand even if nothing about the gold story has changed. A stronger dollar is a headwind for gold almost by mathematical necessity, independent of sentiment. Third force, liquidity and leverage. When financial conditions are tightening, central banks pulling back, credit getting more expensive, margin requirements rising, leveraged positions across every asset class become more fragile. Gold, despite its safe haven reputation, is also one of the most heavily traded, most leveraged commodities on the planet through futures markets. When liquidity tightens, the most crowded, most leveraged trades get unwound first, and in October of 2025, gold was arguably the single most crowded macro trade in the world. Now here's the part that explains the violence of that October crash specifically. In the days surrounding the peak, you had elevated real yields holding firm, a dollar that strengthened on the back of easing trade tensions, and a leverage structure in gold futures and options that was as stretched as it had been in years. All three forces pointing the same direction, all at the same time. That's not a coincidence. That's a convergence. And when all three structural forces align against an asset that's already priced for perfection, you don't get a gentle pullback. You get a flush. So who actually sold? Because the market sold is not an answer. Markets don't sell. People and institutions do. And they each have their own reasons. Let's break the selling into three realistic groups, because this is where the conspiracy theory falls apart, and the real explanation gets more interesting, not less. The first group is the forced liquidator, an entity under acute financial stress with no real choice but to sell into whatever bid is available. In commodity markets generally, this often looks like a heavily leveraged trading fund facing margin calls of its own, or a smaller central bank or sovereign wealth fund that had built gold reserves and suddenly needs liquidity for an unrelated crisis, i.e., a currency defense, a budget shortfall, a debt payment due in dollars that has to be met regardless of what gold happens to be doing that week. Illustrating the pattern, imagine a mid-sized sovereign fund holding $2 billion in gold reserves that suddenly needs $800 million of hard currency within days to defend its own currency peg. It doesn't matter what gold's long-term thesis is. It doesn't matter if the fund manager believes gold is going to $10,000 eventually. The bill is due now, and gold is the most liquid asset on the balance sheet. That sale has nothing to do with gold's fundamentals and everything to do with the seller's separate emergency. The second group sells not because they're desperate, but because they're funding something else entirely. Picture a government running a persistent fiscal deficit that occasionally rebalances its reserve holdings, trimming gold to fund a budget shortfall, or a mining company selling forward production to lock in cash for a major expansion project, debt repayment, or shareholder buyback program completely unrelated to any view on where gold is headed. A mining company that just issued debt to fund a new mine doesn't sell its gold hedges because it's bearish. It sells because the corporate finance plan requires the cash now, on a schedule set years in advance. This is selling with a totally different motive than gold is going down. It's selling because an unrelated obligation has a due date, and gold happens to be the funding source. The third group is the most mechanical, and it's the one that explains why crashes accelerate the way they do. This is the leveraged and derivative trading community. Funds and traders who hold gold not outright, but through futures contracts using borrowed money, sometimes with leverage of 10, 20, even 50 times their actual capital. When gold starts falling, even modestly, these positions hit margin thresholds. The broker calls and says, "Post more collateral, or we close your position." If the trader can't post more margin, the position gets liquidated automatically, sold into the market, regardless of what the trader believes about gold's future. That forced sale pushes the price down further. That further decline triggers the next tier of margin calls, which triggers more forced selling, which pushes the price down again. This is a mechanical feedback loop, not a decision. Price falls, margin calls fire, forced selling hits the tape, price falls further, and the cycle repeats until the leverage is purged from the system. In a market as crowded and leveraged as gold was heading into that October peak, this loop alone can account for the bulk of a 6% single-day move, completely independent of any actual change in the reasons people wanted to own gold in the first place. No one coordinated these three groups. The sovereign fund defending its currency has never spoken to the mining company funding its buyback, and neither of them has any idea the leveraged futures desk 3 floors down at some bank is getting margin called at the same hour. But each of them acted with complete deliberateness in their own self-interest for their own reasons. The crash was the sum of many separate, purposeful decisions colliding in the same narrow window of time, not a conspiracy, just a pileup. And that distinction is the single most useful thing you can take from this video, because it tells you something the headlines never will. Whether the selling is about to continue, or whether it's already run its course. Here's how you actually answer that question, and this is the part of the story almost nobody covers, because it requires looking past the price chart entirely. While the futures market was unwinding its leverage and the price was falling, the buyers on the other side of those trades were not retail traders chasing a falling knife. They were central banks and long-horizon institutional buyers who had been accumulating for over a year. And the demand data through that period tells a very different story than the price action does. Central bank gold buying throughout 2025 ran at a pace consistent with some of the strongest years on record, with institutions like the People's Bank of China and the Reserve Bank of India treated by the market as persistent, programmatic accumulators rather than tactical traders reacting to weekly price swings. These buyers don't think in days or weeks. They think in years and decades, and their stated rationale, reducing concentration in any single reserve currency, doesn't change because gold had a violent Tuesday. When the October crash hit, multiple reports in the following weeks noted that physical demand and central bank purchasing did not evaporate. If anything, lower prices were treated by long-horizon buyers as a better entry point, not a reason to retreat. That's the signature divergence, price falling sharply on forced, leveraged selling, while underlying physical and strategic demand held or even firmed at the lower levels. This is the core mechanism you need to internalize because it applies far beyond gold. When forced sellers meet strategic buyers, the price falls in the short term and the asset migrates from weak hands to strong hands. That's not a thesis break. That's a transfer of ownership. The leveraged trader who got margin called didn't sell because he stopped believing in gold. He sold because his broker made the decision for him. The central bank on the other side of that trade didn't buy because it has perfect timing. It bought because its multi-decade rationale for holding gold didn't change between Monday and Tuesday. Price told you one story that week. Ownership structure told you a completely different one. Now let's connect this to the actual structural plan. And to be clear, plan here doesn't mean a plan to crash gold. It means a macro trajectory that makes any short-term decline look more like temporary suppression than permanent reversal. The number that matters here is the U.S. federal debt, which sits north of $38 trillion. The interest cost alone on that debt has climbed to roughly $1 trillion a year, a figure that now rivals or exceeds entire categories of federal spending that used to dwarf it, including defense. That's not a politically charged statement, that's arithmetic. Here's the bind. The Federal Reserve and the Treasury are stuck between two pressures that don't have a clean simultaneous solution. Push interest rates high enough to convincingly stamp out inflation, and you make the interest cost on $38 trillion of debt brutally expensive year after year, compounding the deficit problem. Push rates low to ease that interest burden, and you risk reigniting the inflation that real interest rate suppression always tends to produce, because cheap money chasing the same goods pushes prices up. There is no rate level that solves both problems at once. Whoever sits in the Federal Reserve chair inherits this same trap, regardless of party or personal philosophy, because the trap isn't political, it's mathematical. It's baked into the size of the debt itself. History has been here before. In the years following World War II, the United States carried debt levels relative to its economy that were comparable to, and at points higher than, today's. The exit from that debt load was engineered primarily through growth, but largely through a deliberate policy of keeping interest rates below the rate of inflation for a sustained stretch, a process economists call financial repression. Savers and bondholders earned returns that didn't keep pace with rising prices, and the real value of the debt quietly eroded over time. Gold, not coincidentally, performed well in stretches where that kind of repression was in effect, because an asset that pays no yield becomes relatively more attractive exactly when the yield available everywhere else fails to keep up with inflation. This is the structural case in one sentence. A debt load this large, with interest costs this heavy, creates a persistent incentive for policymakers to tolerate real yields lower than they'd otherwise choose. And that environment has historically been the single most reliable tailwind gold has ever had. None of this requires anyone to have crashed gold on purpose. It just requires you to understand that the same forces pressuring a government with this much debt tend, over long stretches of time, to push in gold's favor, which is exactly why a sharp short-term flush driven by leverage unwinding doesn't automatically mean the multi-year case has changed. This kind of move tends to follow a four-phase pattern, and it's worth knowing where you typically are in that cycle, because each phase looks and feels completely different from the inside. Phase 1 is the acute shock, the forced, leveraged selling, the headline-grabbing one-day crash, maximum fear, and "I told you it was a bubble" commentary. Phase 2 is quiet consolidation. Price stops crashing but doesn't recover quickly either. Sentiment stays negative or skeptical. Trading volume and media attention both drop off, and most retail observers conclude the story is over and move on to something else. Phase 3 is where it gets interesting and almost nobody is watching. Informed, longer horizon buyers accumulate steadily during this quiet period, while the asset is unloved and cheap relative to where it just was. Phase 4 is public recognition. Price breaks back toward old highs. The same financial media that called it dead starts calling it a comeback. And the people who sold in Phase 1, scared by the crash, buy back in at prices well above where they sold, completing a round trip that cost them money and gained them nothing. In the weeks and months following the October 2025 crash, gold spent time consolidating in a wide range, with one analysis in early 2026 placing the metal's key technical support and resistance zone roughly between $4,300 and $5,400. Consistent with a market digesting the shock rather than collapsing further. A handful of major Wall Street firms have continued to publish year-end price targets well above the post-crash lows, with some forecasts clustering in the $5,000 to $6,000 range for gold by the end of 2026, figures you should treat as one input among many, not a guarantee, but notable for how persistently bullish institutional forecasting has remained even after the sharpest crash gold had seen in over a decade. Based on the pattern, that combination, a quiet consolidation plus institutions still projecting higher prices, tends to look more like Phase 2 than Phase 1. But the honest answer is that you only know which phase you were in after the fact. Now, the part I want to be completely straight with you about, because confidence without honesty isn't analysis. It's marketing. None of what you just heard is a guarantee that gold goes higher from here, or that it goes higher on any particular timeline. Gold absolutely can fall further in the near term. Leverage can build back up and unwind again. A stronger dollar, a hawkish surprise from the Fed, or simply more crowded positioning could produce another sharp drawdown, possibly before any structural recovery plays out. Timing these cycles with precision is something almost nobody does reliably, including the analysts publishing those year-end targets. This isn't a recommendation to buy gold, sell gold, or do anything with your money. It's a description of a pattern and the mechanism behind it. The structural thesis around debt, real yields, and long-term demand is one separate thing. The price on any given Tuesday is a completely different thing. Both of those things can be true at the same time. The long-term case can remain intact while the price does something painful and disorienting in the short run. Understanding that gap, rather than collapsing it into a single verdict, is the entire skill here. So here's the lesson underneath all of it, and it applies to a lot more than gold. Most investors look at a falling price and treat it as the verdict. The market has spoken, the thesis is broken, time to get out. Sophisticated investors ask a different question first. Who is actually selling, and why? Because selling driven by an unrelated funding need, or by a margin call that has nothing to do with the asset's future, tells you almost nothing about whether the thesis is broken. Selling driven by a genuine change in the fundamental story tells you everything. Those two things produce the exact same red candle on a chart. Only one of them should change your mind about anything. Gold's worst single day in over a decade wasn't crashed on purpose by any one person or institution sitting in a room somewhere. It was crashed on purpose by dozens of separate, self-interested decisions, a forced liquidation here, a funding need there, a wave of margin calls underneath all of it, each one deliberate, none of them coordinated, all of them landing in the same 48-hour window. And on the other side of every one of those forced sales sat a buyer who had been accumulating for over a year and saw a markdown, not a warning sign, bought on purpose, with complete clarity about why they were doing it. The price told you a story of panic. The ownership data told you a story of patience. The next time you see an asset crash on a headline that doesn't quite explain the size of the move, remember that price tells you what just happened. It never tells you why, and it almost never tells you who. Tells you.